Hi, everybody. Welcome to Real Siblings. It Ain't Easy, a real estate podcast that just ain't typical. I'm Donna. He's Eric. And you'll see there's somebody else sitting there. And we are the Real Siblings. We are both professional realtors with Keller Williams. And just for your reference, he's in the Central Time Zone and I'm in Arizona, which may or may not cause problems sometimes. This podcast blends lifestyle together with real estate as we work to communicate, educate, connect, and entertain listeners with a variety of topics that vary, and our conversations go in a lot of directions. You know that. We work to provide our listeners with insights into our industry, better equipping them for their next real estate transaction. And for those of you who have watched all 31 episodes,
or listened to
that. Oh, watched or listened to. I do the video piece, y'all. You know that. My brother does the podcast, the part you're supposed to be listening to. So ignore that last line. Anyway, 31 episodes. We're now on 32. And this is Markets on the 8th.
Markets on the 8th.
I don't even know what we're doing, you all. It's a good thing my brother does all this. So, Eric, hi.
Hi. Okay. So 20 minutes ago, she was cleaning chicken off the bone. That's how prepared we are for these things.
Yours are not greasy.
Nothing but professionalism. So welcome to San Antonio, Texas. As you can see behind me, I am in the Thrive Mortgage Media Center, and I have with me my friend and colleague in business, Michael Litwin. He is loan officer I've done numerous transactions with over the years. Most recent 20-acre VA loan that we closed in June. So I'm going to give him a chance to introduce himself. There's a reason he's here with our guest on this market discussion, and we'll get into that.
I'm sure my reason to be here is my good looks, but other than that,
yeah.
I'm out
he has here. This stunning blue eyes every time I look at him.
Fantastic episode. I'm looking forward to this. Let's see, I've been in the business for, banking in general, probably about 23 years. I've been a commercial banker, a retail banker, but my love is mortgage banking. 17 years of a mortgage banker and going strong, or as strong as can go in this market.
Welcome. So you're going to bestow all sorts of wisdom on us today, right? And
pearl after pearl. Yes, ma'am.
Yay. Yay. So you all know that we talk a whole lot about lifestyle. So now and then we feel like we need to talk to you about the numbers. And we have a friend that we grew up with who sent Eric and I a Facebook message talking about pricing and life and where she lives. So she lives in Oceanside, California. And I'm just going to say, Shelley, thank you for the question. She talked about pricing there, and we've had some discussion back and forth, right, about what they pay to rent a 500 and some square foot apartment condo, apartments converted to condos back when the market started doing all that, and how much that has increased through the years, right? She said 55% increase in their rent. And
that's been in like the last 5 years, right? Isn't that when she said
10 years? 10 years.
10 years. Okay. 55% in 10 years.
Yeah. And then I think 30% in the last 5, something to that effect. And that if they wanted to buy that unit, it would be $342 or $48,000.
Yeah. She said $342,000 for 508 square feet.
That's not a lot of room.
No. So her question to us was like, how do people do it? And what do they do? And so I'm going to give this to you for you guys to kind of talk about, what do we do?
Yeah. And we all know from the national news, if you watch anything, no matter where you consume your news, that the interest rates are the thing. And that's why we want to talk California specifically in a future episode, but for quicker response here, reached out to Mike. Mike said, sure, let's do it in the studio. Mike, what is going on with the interest rates?
Well, today was another Fed day. Fed came out, made their announcements. I haven't reviewed the notes, but I'm looking at the market and it's not good. The market's getting pounded again today as well as yesterday. So we're going to be back in the mid sevens.
Mid sevens for a reasonable
credit score.
Which is what's reasonable?
For conventional 700s. For FHA, VA, USDA, above 620.
Okay.
So we're not talking stellar credit. I mean, just it is what it is.
Okay.
The Fed, I don't know how politically you want to get in this, but the Fed is making their decisions based upon old data. That data is now 4-6 months old. So they're making their decisions based upon stuff that.
So they rushed it Typical government
Well, actually,
entity. They
they-
rushed the decision after looking at data 6 months ago.
They-
6 months ago.
So they blew it in the beginning when inflation kicked in. They did nothing, saying it was just transitory, and then they've been ratcheting up ever since. And now they've done so many increases in such a short period of time that they haven't let it filter into the economy yet for it to take its course.
Jeez.
All right,
Right.
so we're not going to talk politics, but you're
Okay,
right.
right. Yeah. My sister really doesn't like to be controversial when it comes
No.
to any kind of look.
Anything.
I just think everybody who goes to Washington DC gets corrupted by the system. Doesn't matter what their intentions are. I think the system is so big at this point.
Power corrupts. Very
It-
simple.
So those of us that are older, I think my first house, Mike, was 14 or 16%. And of course, the price of the house was maybe 50,000. I don't remember. So to hear the interest rate number doesn't seem big to me. And the fact that I have a 2.875 feels like I won the lottery, to get that on my personal house. But I also don't feel like 7 sounds very high. But can you talk about what that even means for the average first-time buyer based on maybe what entry-level homes are?
But you're speaking with wisdom, having the fact that you've seen long-term cycles. If I go back 30 years, the average rate is like 7.25. So we're pretty darn average right now.
Right.
But for everybody who's been in the market since 2008, this is screaming high. This is double what they're used to seeing. So it's all about perspective. So if I look at the long term in my tenure, 7.25, cool, that's average. That's not impeding buying. But for people like yourself, for 2.875, why the heck would you sell?
Right.
So even if you buy a lesser house, your payment's going up. That's part of our problem.
Yeah.
Well, and Donna, you remember, I mean, married couples, statistics will say one of the biggest things that people argue about is the money, right? And I can remember some of mom and dad's biggest discussions on the big Victorian house was making a payment. And when you think about it, in that house in the 70s we figured dad's construction loan was $24,000 total for the house and the construction.
That's an average car.
And they talked about, oh my gosh, we're going to have to do this in order to make the house payment. But I think interest rate at that time, they were probably I'm thinking 15 to 18% from the early 1970s.
And what I don't know is because we never really talked about any of these details as kids.
Oh
I don't
yeah,
know-
we didn't have that information. We were the kids.
Yeah, we didn't know what the mortgage was, but we also, Mike, our dad was also a commission-based salesperson. So we kind of didn't know if there was a good month or a bad month unless it was based on grilled cheese and tomato soup, what we were having to eat, that kind of thing. So that was never part of our conversation, except to hear maybe some of the worries, right?
Right. And at some point, mom and dad refinanced too, right? When mom had her surgery, didn't they have to do, I thought there was some refinancing that had to go on in order for mom's cancer surgery. Or some back, maybe it was her back surgery that she had. I don't remember, but I think at that point there was something that they had to do a refinance, and that the refinance raised their monthly payment.
That's interesting. Yeah.
So even though the loan went down, they borrowed against the value of the house and refinanced or second mortgage or something in there.
And the payment went up.
But as usual, we're going off track. We want to stay on to where we're
Eric, talk about how many houses are on the market there, because you and I talked about that a little bit.
Okay, yeah. So we did pull some actual statistics for each of our own markets, and right now at the end of August, and I say right now, so obviously it's September, it's no longer the end of August, but those are the numbers we have reported. When the multiple listing service closed, we had 11,467 houses on the market, which year over year in San Antonio represents a 24% increase in the number of houses on.
Wow. And how big is, when you say San Antonio, because I don't really know your MLS well, like you have like the inner circle and then you get the bigger circle and the whatever. How
there are a couple of other MLSs that come close to us. Probably the second biggest that's close to us would be what's referred to as Four Rivers, and that's New Braunfels. New Braunfels finally got big enough. They have created their own separate MLS. There's a couple of hill country ones. Kerrville, which I'm also a member of, only has 242 houses on the market. So
Separate MLS?
yeah, separate MLS, 242. So, and that's 2 counties away. Kerrville is one of those counties that doesn't actually touch Bexar County, but if you're Bexar County, which is where San Antonio sits, is surrounded by 8 other counties that at least in some small portion are contiguous to it. And our MLS covers all of those.
All right.
So 11,000 houses in 9 counties.
Okay. So Mike, so if of those 11,000, 3,000 are in the price point for a first time buyer, I'm just picking some random number. What do those first time home buyers, Eric and I talked about how many military you have there and what the income is for Air Force enlistees and things. What have you seen in how you're structuring loans for first time buyers at this higher interest rate?
So, I mean, it becomes a lot more difficult. I mean, so we know that the payment now is a good third higher than it was last year, just because of interest rates, things that sort, plus appreciation.
So third higher, if they were borrowing $200,000.
Now they're borrowing, there's not a house for that anymore.
Right, that's
Okay.
true.
Those houses don't exist anymore. They either
And
gone
so
up in
how many
price-
are getting the buy downs, are asking sellers to pay costs for them?
So, I mean, within the last couple of months, that's actually become not common, but I see it now. Up until this point where it was almost a unicorn where a seller was paying somebody's closing costs. Now it's becoming a little more common. I mean, prior to COVID, a good half my contracts had some kind of seller concessions. During COVID, they laughed
None.
at them. And now that it's starting to creep back in a little bit as things age a little bit on the markets.
But is that closing costs or contributions to buy down interest rates? Because
So you can use it
do
you can use it in any fashion that you want.
okay.
So the buyers can give X amount of money towards the seller's costs based upon the loan program and the down payments, and they can use it whichever is their best benefit to them.
Okay. So if you have money to actually put down,
Yes.
and rather than take some of that money to put down, so you're doing an FHA, 3.5% down is normally what we're looking at, but you actually have a little bit more money on that. It would make more sense rather than put the money to additional down payment. We're at $10,000. Use that to buy down your interest rate rather than finance or finance less money. Save us more money on a monthly basis, doesn't it?
So every $1,000 you give me, your payment's going down about $6.
That's
So it's not an earth-shattering payment difference by giving me more money.
Okay,
to
so that's
reduce
if it's $10,000,
That's $60. roughly.
$60 a month. But if I buy down the interest rate 0.25%,
Depending upon your loan amount, that could or could not be a big change in your payment. So
And
that was depending upon how much you're borrowing, you'll determine what you're going to be at.
yeah. So
that's what
if you've
buys.
got the money, it may make sense to talk to your mortgage lender, your loan officer, your professional real estate agent, and say, what's the best way for me with the money that I have?
So let me throw a wrinkle in there. So back to all the volatility, we would have this something called a par rate, which is a rate with no points.
Okay.
right.
Those don't exist right now. There's so much
Mm.
volatility in the markets that the back end investors where they're sold as mortgage-backed securities, they don't really want them. So there's no par rate. So you can't find a rate without paying 1 point now.
That's
It's not
fascinating.
available on the rate sheet because they know
And-
that probably next year rates are going to be cheaper. So they're going to refinance, they're going to run off.
And explain to our
Wow.
younger listeners, because I have a buyer right now that is buying a new build and they talked about this 1 point thing and he had no idea what they were talking about. So tell people what that means.
So 1 point is 1% of your loan amount. It's a fee that's being paid to get a interest rate. So traditionally that, just for example, 7% would be your par rate. So that means that's the rate you're going to give with no points. If you go above that, you'll actually get a credit. So negative points. So here's $500 if you take 7 1/8. But if you want to go down to 6.875, it's going to cost you $500. So that point structure changes per loan type, per day, per credit score. There's a lot that influences how much your money's going to buy you down.
Right. So it's very much an individual basis, but
Absolutely
in
is.
general terms.
In general terms, 1 But in a normal market, 1% will get you about 3/8 less of an interest rate.
Okay.
Nowadays, it might get you an eighth, or it might get you a full point.
Wow.
It's all over the board.
Okay. So again, make sure
Fascinating.
everybody's understanding what we're saying. So if you have a let's say $300,000 house, since we said $200,000 houses don't exist,
Just
$300,000 house, 1 point, $3,000 down to change your interest rate by 3/8 of a
3/8.
percent.
And in the mortgage world, the general rule of thumb is if you recapture your costs in less than 36 months, it's probably worth it. So that means that if your monthly payment difference between the no points rate and the points rate, that difference divided by what you're paying for it, recapture your costs in 36 months, it's a decent investment. If it's not, then probably not, because you're probably going to refinance and do something earlier.
So 36 months, is that based on buyers moving? A buyer going, I'm only going to be in the house this
X
amount of time.
That's if I average it out, yeah, it's kind of 36 months.
Okay.
But honestly, if I'm telling people that if you don't have to pay points right now or pay the least you can, because we suspect next year sometime there'll be a refinance boom. We're supposed to be back in the fives. So the
And that we just had our stats class, and that's exactly what they said. So he was talking about staying in touch with your sphere from the perspective that suddenly 5.5 is going to look good.
it's gonna look
compared-
great.
Right. And so people that are waiting or on the fence are thinking about that. I typically, when I'm talking to a buyer, just so you know, my conversation around this, if the seller's not going to help them buy down the rate, the question becomes, are you on a fixed income where you know absolutely what you're going to make every month, and that $50 difference a month in your mortgage payment will affect your food, your fun, your whatever, your uniforms for your kids' sports. I don't know. And that to me becomes the question of whether you spend the money now or later, and what somebody can afford from a rate buy down. Because for some people, $50 is a lot.
Yes.
For others, it's not. Right.
But I also, with my clients, it's like, look, I don't want to make you house rich, cash poor.
Right.
Because just because you get approved up to this doesn't mean you should try to shop up to that. If you can find what meets your needs, requirements in the area that you want for less money, why would you not do that instead of going, oh, I got approved up to $350,000? Because we know property taxes are only going one direction, and that ain't down. And
thumbs up.
we know insurance is doing the same thing.
Yeah.
Hurricane, what is it? What was the hurricane we just had that hit Florida that Rich had to?
Oh,
I something. Anyhow,
that was Ian. He had somebody else.
Yeah, Ian was last year. This was the I want to say idolatry, but I don't think that's that's quite right.
Oh my gosh.
Okay, so in addition to that option, down payment assistance?
Down payment assistance sounds sexy. And
that's what I always say.
It sounds sexy.
Sexy, free money, but there's really no such thing as free money. So just for example, today we're using 7.25% for an interest rate. Down payment assistance, you're 8.25%. And if you go down payment assistance, you can't refinance next year without a penalty. So is that really the best way to go? So now I'm stuck at my 8.25% for 3 years. I got to pay some of that back. I think it's pretty expensive.
Wow.
And then furthermore, now I'm qualifying at 8.25%, which makes it even harder to qualify for the first-time home buyer. I've done 0 down payment loans this year because they don't make sense.
Because they're not helping. And is that a federal or just a state, or is that across all programs?
Across all programs, because once again, there's no stability in the interest rate market. So the down payment programs don't have any margin in which to figure stuff out. So they have to shoot so much higher when they issue out their funds.
Jeez.
Eric, do you remember when we had Rachel on and after we hung up, from the recording and she asked us a few more questions. We talked about the commission for realtors across the country, and the kind of the standard that we're not supposed to stay as a standard or whatever. And I talked to someone yesterday where they were saying that in certain places it's always 2.5. And I am wondering even how our income as realtors, may or may not be affected by everything that's happening in the market. If sellers are making less, if buyers are paying more, if, commissions and everything will change related to that. Have you seen any playing around with that in San Antonio? Not yet.
No.
Interesting.
No, and as you're saying that, I'm thinking through, number one, there was an article that just came out, two more brokerage chains nationally settled on a antitrust legislation that's going on. And that's the one that they said the antitrust, one of the two of them was worth $40 billion.
Yeah, that was $4 billion.
And the other one's $4 billion. It's like,
Lots
who
of
cares?
billions.
Yeah, it's only in the billion.
Wow.
But no, we have not been seeing that here. But it made me think that conversation, because I know there's a couple of states where buyers have to pay sales tax.
Yeah, like Maryland's one of those.
So if you're in Maryland and you're paying commission and you're paying sales tax and you're using part of that to go, hey, seller, you need to help me pay some of the sales tax to buy the house that you want me to buy. And that's a fixed rate. That's not negotiable. Guess what? So they want you as the agent to to work for less.
Mike, can I ask you, this is personal related to your business, because all the lenders I know that were just kind of like overwhelmed during the 4%, 3%, whatever the refi, what has this done to you or your team or whatever, this change in the interest rate? How has that affected your production?
It's been 3 times as much work for half the business.
That is exactly what somebody said yesterday, because
the amount of work we have to do, and because the rate is so high, every buyer thinks they're getting ripped off. So they're going to shop 16 different lenders. So I have to work 3 times as hard to get the same amount of leads. And all those leads that I go to contract, half of them leave because they go to some strip rate market that has a lousy experience, but they're after an eighth cheaper.
And do your new home builders do the same? I've had my lender who has lost 2 to the new home builders that are offering.
Oh, new home builders are being very, very competitive because they get everybody to use their financing in order to, hey, we'll pay your closing costs.
Yep.
If you finance with us, and oh, by the way, we'll give you this finance rate. And
the utility or the refrigerator, blah, blah, blah in the house for some of them. And yeah, that's it makes, I mean, I'm happy for the buyers, right? One of Caleb's friends just did this with a new build. And simultaneously, it makes me sad because my personal friend and lender is the one that pre-qualified them first, right?
Right. Couldn't get in and couldn't get that.
Yeah.
That's known as steering, but it's legal.
Yeah. So the other day, when you and I talked about this and putting it together, you were talking about your 5-4-3.
I prefer 3-4-5, but yes.
Okay, 3-4-5. So whichever way, explain that to the listeners about.
So the listeners, I had figured out that you can purchase in increments of your annual salary. So a conservative buyer is going to pay a house that is roughly 3 times their average salary. So if I make $50,000, I have a minimal down payment, minimal debt, I'm going to probably buy about $150, or 3 times my average. The average buyer, 4 times, $200. The super aggressive buyer, $250. So they're going to be pushing the absolute envelope of their debt to income ratio. So as rates keep going up, I'm going to be down to 2.5, 3.5, 4.5 for my
for your
purchase power. But yeah, that's kind of been the rule of thumb. So back when we were in the 2s or 3s, I was at 4, 5, 6.
Right.
So that's obviously going to be indexed as rates go up and go down. But
And
that's
of course,
a super easy way to find out your price point.
But that goes back to the fact that part of that conversation also was that, okay, how much house can you buy if you're a minimum wage worker? And your response was?
You can't. Minimum wage has never been designed for you to be able to buy a home. It's minimum wage. It's your entry-level job, and it does not come with entitlements. It's enough to maybe feed yourself and get a car.
And we even went to ask the question, and part of that discussion was, okay, but that's a lot of minimum wage jobs don't actually get 40 hours a week either. So what if you're actually in a minimum wage and making 40 hours a week and you still not in a position where you're able to buy?
I got to tell you, I'm playing with numbers ever since you said that, Mike. I'm like on my phone. So if it looks like I'm ignoring you, it's because I'm doing math on my
That's
phone.
fine. I guess my information is lousy.
But I've never heard that like that. And I read what Eric had emailed, and I think that that's part of the reason. So again, I'm going to go back to Cassidy and Ariana. I know what they make. I know what the builder said they could qualify for, and they were like, we're not going to spend that much money. So what? And that goes back to the being house poor, but I also took I took my income, and I'm like, there's no way in hell I would spend that much on that house, and I know I'm super lucky because I'm at 2.85% and I don't owe that much. So I know that.
And you're happy in your townhome community.
I am. I don't need bigger, better, brighter, and polished, because there's very little about this that is that. But
very little about that. You've got a room with a view. Look at those flowers. Look at those flowers in the peak behind you. That's just not over your fence.
No, this is totally what I see behind me.
I need to add a public service announcement about what the builder says you can afford.
Yes.
So the builder is going to give you a artificially low payment to make it more inducive for them buying. So we know the first year's taxes are not legitimate.
Are nothing.
Right? So they're using a fraction of the taxes. Yeah. We know that a brand new home has very inexpensive insurance. It's brand new. Nothing's going to break.
Okay, so I want to, when you say we know the three of us that are sitting here on camera. Explain what you just said in that we know the first year's taxes. And this is property taxes.
Property taxes. So when the builder has a property, it is just land. The price of land is way different than once you put up a house there.
Right.
But the builder is going to use some kind of aggregate of land plus house to make the taxing value. So the property taxes are going to be significantly less the first year than they are going to be subsequent years.
Right. So a house, if someone's buying and they close, let's say November of this year, and it was a new build, then their 2024 taxes are going to be less than what when reality hits in 2025.
Absolutely, yes. So they're going to use a factor of like 1.8 versus 2.8. Here, local.
So that being said, I'm thinking about this. I call it these kids. He is total commission. She is salary plus commission. So I know right now that would essentially say they could spend $775,000, and they were like freaking out that they qualified to do 415 and have been playing with the numbers over and over and over again. And so does Mike, from your perspective, if it's that kind of a job, one is total commission, one is salary plus commission, and they have a couple of years, does a lender take into consideration that, like, I've had a really good year and I had a really good year last year, but next year could suck?
So we're fortune tellers, but we're backwards fortune tellers. So we base our decision based on history. So a commission person, we're going to look at the last 2 years. So we're going to average that out and assume that's what you're going to kind of project into the future. So that we have no idea what's going to happen. So we just use the best available data that's out there.
That's okay. And since we brought that up, what about, what do they call it? Bank statement loans. So for those people who make a lot of extra cash, but don't make it in something that's a 1099 or a W-2 or something
so
like
even those that do self-employed 1099 people, they make a ton of money. Their account is creative. They make $0 come tax return. So I look at that and go, you made $3.50 this year. You can't buy anything. But my bank statement says I make $20,000 per month.
Right.
So those are considered non-QM, non-qualifying mortgages. So those are not sold in the secondary market. So they have different rules. So there's banks out there that will take your last 12 months, average it out, give you some kind of expense factor based upon the type of business, and that becomes your effective income. So the rate's going to be higher. Might be a point higher, might be 2 points higher, but those 2 points might be less expensive than declaring all of your income and getting whacked with a huge IRS bill.
That's interesting. I haven't heard those specific words that I've heard people say, they're telling me I can't buy a house and I have a bunch of money. And I'm like, well, what does your taxes say? Yeah.
Well, and I don't know about Tucson, but San Antonio has a lot of people who don't get a paycheck. They get or a check at the end of the week, and they go in and they leave a thumbprint at the bank. They cash the check.
Wow.
Somebody gets 80% of it. They pick up their 24-ouncer on the way home 5 days a week. And there's no record of it. Or
Wow.
someone who works for tips. And it's like, look, I make $1,000 a weekend in tips. Well, guess what? If it doesn't get put into a bank account where you have some sort of record to prove that you're consistently making that money, and even those are getting more with the interest rate going up, they're going,
Yeah.
I don't know.
Yeah.
Yeah.
So, we're, we've got our little timer on our computer now.
I was going to
telling
say, is the timer coming up?
us-
We've talked
But-
too long.
I want to ask
No.
Mike, Mike, do you have any parting words, related to lending and mortgages and the fact that always owning a home is better than renting?
But
I-
see,
I
you've
just-
got the look at the cost of waiting. So
Uh-huh.
rates are not great. We know that. But if I wait till next year, what's that going to look like for my entrance price? Odds are good. When rates go down, demand's going to go back up, and rates are
Yep.
going to start ticking up.
Yep.
So if you do the math and look at the numbers, you're better off holding your nose, buying now, and then just refinancing next year. You're going to be further ahead as far as equity and payment and cost.
Good point. That's good information, and I agree. All right, Air.
Wait, I have one more point. So,
Wait.
and a lot of banks, well, including Thrive, that we know rates are not great. So buy now, we'll give you a no-cost refinance within the next 18 months.
I've seen that, and
It's
yeah,
kind of a win-win.
That's up to 18 months. So if they're thinking, so we talking mid-year next year is when they're thinking we're going to be down 2%.
That's kind of the projection.
Okay.
I mean, they've been wrong this year.
So May, June timeframe is.
yeah, they projected we should be back in the
That's right.
fives
It's
now,
happening
but,
then.
yeah.
who knows?
Yeah.
Happening then. So what were you going to say to me, sister?
I was gonna say, Eric, close this down.
Did we get it all?
We
Wrap it up.
did. Yeah, I know. We danced around
We
that.
danced around.
So doesn't this look official? Newsroomy and all?
It looks,
I want
yeah.
to thank everybody for listening and joining us as we've recalled How Life in Lindsay. We did talk about the house in Lindsay very, very briefly, but we really wanted to focus on the markets. And since we did have the question about getting into the market and what are some of the considerations for buying, we wanted to address that. Generally, we take real estate and lifestyle, blend the two to add to this conversation. And our goal is to communicate, educate, entertain, and connect with you. Remember, both Donna and I are real estate agents with Keller Williams. I'm with Keller Williams Heritage in San Antonio, Texas. Donna is with Keller Williams Southern Arizona in Tucson, Arizona. And we would be happy to help you if you need help in those areas. If you're around the country or around the globe, we have a vast network of real estate agents that we can connect you with. I'm reaching out to Dublin right now for a client.
Yay.
Extensive networks. Let us do the work for you to connect you with a great real estate agent who can help you out. And remember, it may be simple, but it ain't always easy. And until next time, I'm Eric.
And I'm Donna.
And we are Real Siblings.
Siblings.
Mike's not a sibling.
I'm not a sibling. I'm just
It's
real.
okay, Mike. It's all good. It takes us forever to get that together. So I'm gonna end it now.